Hi all, I am Sham and I have Kishan with me.
Hi, Sham.
Welcome to Free Float. Over the last few weeks, we've been discussing investing in the US through ETFs and why it makes sense and so on. Today, we're going to broach the subject of actually transferring the money and what that involves and whether for an Indian investor, is it still worth it? Before we jump in, Kishan, have you ever transferred money to the US?
Yeah, me and I when I worked in the firm, we had an interactive brokers account. So I actually did the paperwork that was involved some 5-6 years ago. Of setting up a US trading account, and then over time, even I've bought some US stocks, like Twitter and Dropbox and that's stuff that
Deep value.
Yeah, and I've also helped a few clients set up accounts. So the process is, how do I put it? The account opening process of interactive brokers is seamless. It's so nice. You can do everything online. You can go to a client and you can talk about it, and if he says yes, you can do it right that second. You can in that within half an hour you're done. You're out. The problem comes, in actual transferring money, because the client needs to go to the bank, and sign some forms, and most people, find it a headache. So, and then it comes the actual trading part, because your taxes, your filing and stuff becomes very complicated.
Right. Yeah. So, my experience has been similar. And the reason, why I wrote this article was partly to clarify my own thought process. The number one reason why you should transfer funds to the US is if you want to access, specialized strategies. I would say that's the number one reason. So if you want to do like momentum investing in the US, combine it with say momentum investing in developed markets, right? It's just two ETFs. You can buy it, keep it there, and forget about it for the next 15-20 years, and they're going to be fine. The problem comes when you want to go through the actual process of this whole LRS, which stands for Liberalized Remittance Scheme. So we try to do it only like once a year. So we save specifically for this, and we go to the branch office, and it's like 2 hours of your life that you're never going to get back. The format of the forms keep changing, so you can't just blindly fill it up. You have to actually read the damn thing, and there are like 4 or 5 different forms because they need to send a copy to RBI as well, I think. I don't know. And generally, it just feels that I'm getting ripped off every single time by the forex trading desk in Citibank. I never get the rate that I see on Google. Like if you Google USD INR rate, you'll get something, and if you look at your bank statement after a week, after they've done the transfer, and you say, okay, my interactive brokers account has $10,000. So how much money did I actually send to Citibank, right? And you just divide that by that $10,000. It is like 3 to 4% off. So there are like not just fees. I think most investors look at transfer fees and try to find the cheapest, but it is not the transfer fees that gets them, right? So the fees that most banks charge are mostly flat. It doesn't make much of a difference. GST everybody pays, but I think what makes a big difference is the FX rate that you actually end up getting, And if you're transferring small amounts, then you get the retail special rate, which I think is completely off. It is somewhere in the ballpark that they can get away with, without getting into trouble with compliance, but it's almost always like 3% off. So this brings like an interesting conundrum, right? So if you invest the same amount in India, if you're buying, say, the S&P 500 index fund in India, for all the $100 you put in minus some, stamp duty, which is like some 5 paisa or whatever, so you get that index fund. Whereas if you do this LRS route and buy an S&P 500 index fund in the US, you're starting from 97 rupees, not $100.
So you're already down 3% from there.
Yeah.
But Shyam, you're creating a dollar asset. I mean, this 4% that this 3%, but you'll make it up if the rupee depreciates 4%, because that's been the inflation differential between the two countries.
Right, but the thing is, you're going to invest in an S&P 500 index fund in India, which will have the same benefit. Right.
So, no, I mean, yeah. So I get that point where but your money is going out of the country, because the problem is, if you buy an S&P 500 fund, when you want to redeem it, it comes back to India. So you're not really creating a dollar asset, but if you say want to have a dollar asset for future, either you think you might move to the US, or you might send your child abroad to study or something. It makes sense to have this, because you don't also have to you're creating, and it gives you more options, obviously, like.
Yeah, so look, for most of those use cases, if you're just buying an index fund in India, an S&P 500 index fund, you're going to be indifferent, right? Because if you're going to send your kid to college 5 years from now, and you buy the S&P 500 index fund, it is no different from sending the money now and buying it there. So it's no different. So the thing is, there is a point of indifference, and that is the differential in fees. So if you look at the Motilal S&P 500 index fund, it charges you 50 beeps, which is the maximum. I think 49 beeps, because 50 beeps is the maximum allowed by SEBI for an index fund. Whereas Vanguard's S&P 500 ETF charges you 3 beeps. So for the same return, right? So for the same index fund, you need to wait for 7 years before you become indifferent between sending money and buying that ETF there versus buying the same index fund in India. So for me, it comes down to what is your use case, right? If you're just going to buy some lame vanilla, index fund like NASDAQ 100 or S&P 500, and you're going to get in and out of it in less than 7 years, then it makes no sense to do this LRS stuff, in my opinion, right? So you can just buy those index funds in India and sit tight. The use case actually is if you want to access other strategies rather than vanilla, like if you want to do some factor investing, momentum, quality, value, whatever floats your boat. There are ETFs for all of that in the US, and it makes sense to sort of use that.
Right. But then suppose if in the future some Indian fund house provides those also, I think it's quite imaginable that will happen. Then would you say that
it is not imaginable that it will happen? I can't imagine that happening, actually. So the biggest reason is that
fund, right?
What?
Like BlackRock or something can have a feeder fund in India, which does that.
BlackRock is not even in India, dude. So I'll tell you one thing that I know about the Indian mutual fund landscape. There zero there's zero interest in the mutual fund houses to antagonize the existing distributor network. They are heavily dependent on that. And the minute you start saying feeder fund and a wrapper on some index fund in the US, the fee you can charge for that comes down drastically, and you can't pay commissions to your broker network. So there is no nobody's going to push it, and without pushing, nobody's going to buy it, and it'll end up being some small 20 crore 30 crore sort of fund for the AMC, and they're going to discontinue it, within 3 or 4 years. I just don't see how anybody can break out of it. If you see, most of these guys, they're wrapping active strategies primarily for that. So you see fund of funds of active US mutual funds because of SEBI rules, which says, which caps the fee they can charge on index funds. So even when they do release it, the fees are going to be, sufficiently high that whatever alpha you're getting is going to be eaten away by the fees. Right?
All right.
So anyway, I don't see those fancy strategies coming to India, and and here more than anything else, they're interested in selling stories. So if you see Mire's, Fang Plus, right? It's a bunch of extremely overbought US companies and completely fraudulent Chinese companies. But they're selling it saying, it is some fantastic global diversification, right? So the thing is, mutual funds love to sell stories and not not strategies per se. Primarily because of the broker network that they are enslaved to. So that is one thing. So second thing is, it makes sense if you have a long enough time horizon, I feel. So if you're looking at 10 plus years, it makes sense to send money out in one shot, or as infrequently as you can, like once in a year or once in 2 years or something. And create this asset. And the reason you create this asset is if you or your next of kin is permanently moving to the US. I feel that's the only use case for creating a dollar asset. It doesn't matter whether it's stocks or buying a property or anything. So the reason why you create it is so that you send your son to the US. And India, you say that I'm gifting this US brokerage account to my son, right? So when you do that, in India, it's tax free.
Yeah.
So so you can either sell it, put everything into dollars, and then just give a brokerage account with just US dollars in it to your son, and it's going to be fine. So that's one big use case that I see. And if you're interested in that, you should make sure you have a long enough time horizon for all these fees and everything to kind of even things out for you. The second big advantage I see, I don't know how long this is going to last, is US does not have STT.
Yeah, so, and there's been a lot of clamor for like a STT kind of a tax.
Yeah, there is a lot of clamor for it, but exchanges are pushing back, and they're saying that if you do this, we'll just offshore ourselves or whatever, right? So it's like it'll just kill half of the US securities industry if they slap any securities transaction tax. They'll nibble around the edges in terms of incentivizing high frequency trading and so on through this, but I doubt if anybody will get on board, especially with the Republican filibuster still intact. I don't think there's a chance of STT coming in the US. So if you have a high frequency strategy, right, high frequency trading, I wouldn't say high frequency, like say you have a high turnover strategy, it makes sense to do that in the US rather than in India. So if you look at some of these Momo strategies that we have going, right? So, so it makes more sense to do it there than here, uh, assuming your rate of return is the same. So everything being the same, right?
Yeah. Yeah. I mean, I get that, but Sham, I mean, would you? I mean, the other reason why people like to do this, is I mean, how to put it? It's a thing that looks good, right? I mean, people like to go and talk to their friends that they have that they invest in, not only that they invest in US stocks, but actually have a US account, and they have it sounds really good to tell people that they've invested in stocks abroad, and not from mutual fund, but actually have a dollar asset, and they're creating a dollar asset. It makes them you could say ego, but it's like a social validation thing.
I can't argue with that. I mean, it definitely sounds glamorous, and I just hope that something like this exists in Japan as well. Because I mean, I think it would be really cool to tell people that you have a Japanese brokerage account and you trade Japanese.
Yeah, I can imagine, people saying that you invest in Zomato. I'm investing in some Japanese medical, robotic company. I mean, what are you talking about? So I can imagine. People saying that.
Yeah. So, so I guess that's one thing you can't argue against. There is a bit of bragging rights attached to this whole thing. But as a numbers guy, I just I want my people to sort of walk into this with their eyes wide open, because at the end of the day, in a bull market, everything washes out. All these bragging rights are great, but once the bear comes around to embrace you, you start looking at your fees and how much you spent on different things, and you'll that shouldn't come as a shock to you at that point. I feel if you're doing some sort of active strategy, there is a tipping point based on your turnover where it makes more sense to do it in the US than in India. But and in there is the last thing, which is sort of it concerns people who are looking at this as an endowment, right? So the problem is US estate taxes need to be navigated, especially for high ticket accounts. Like if you have more than 60 grand in US assets, you need to file an estate tax form to the IRS. And for that, you need a US lawyer to do, because Indian lawyers have no clue as to what this is. Like, I had an interesting situation where there were persons of Indian origin, but were US citizens who had come back to India and wanted to invest in Indian stocks directly. And according to US laws, you're supposed to declare, you have to file like once a year, right? Like what you own, like your foreign assets. And no Indian chartered accountant could help them with that. So so I told them that, look, your best bet is to go to KPMG or someone and get this done. And unfortunately, their asset size was not big enough for KPMG to look into. So there are all these small gotchas when it comes to taxes and compliance that come into picture when you are doing this sort of thing. So, for example, even in my case, I cannot trade US stocks because my wife works in Goldman Sachs, right? So, there's like a shitload of insider trading laws that I'll be violating if I do that. So I end up buying, so they have a whitelisted set of ETFs that I'm, only those I can buy. So um, so I end up buying those, thinking that in a long enough time horizon I don't need to worry too much about all these transfer fees and the cost of filing taxes and so on. But even even if you don't have these rich world problems, you still need a chartered accountant to file your taxes.
Right.
Once you do this LRS, it's a given. Like, I don't know what some of my friends are thinking, transferring like 5K, 10K and all that to their brokerage accounts and trading a little bit just to feel a bit fancy. But it's just bringing on, uh, a ton of compliance and tax issues on their head. And this can haunt you for the rest of your life, because Indian tax guys can come after you in after 10 years. So you can file today and think, oh, I didn't get audited, but they can reopen your case 10 years from now and start asking questions to you.
Yeah, but I mean, talking about US assets, I mean, people are doing this for crypto, and and crypto is like, that's something that will get, people will be in problem, down the line. So
Yeah, crypto is like freaking radioactive, right? It should be called kryptonite, because it'll bring you down to your knees when it comes to taxes in India. And it's not just taxes, with crypto, right? So see, with the LRS, you're doing it in a legally allowed way, right? You're going to a bank, you're transferring funds, and that gets reported. So at least that part is taken care of. This crypto thing is straight up hawala, right? So they will make you go, and ED will summon you at some point and say, you explain all this to me. So you're kind of jacked.
Yeah, it's very risky.
Yeah. So I don't know what these guys are thinking, but I hope all these guys know a good chartered accountant and lawyers to help them out when time comes. And that's why I feel you should walk into these things with your eyes wide open. Make sure you covered all your bases, even though you may be doing it for esteem, for increasing your esteem. Doesn't mean that you shouldn't think about these things. Anyway, I think that pretty much covers why you should do it, what your ideal time horizon should be, and the sort of strategies that make sense if you if you plan on trading. So the second thing is, even in trading, right? Kind of counterintuitively, it doesn't make sense to trade less in the US. So it's kind of like your options are binary. So you either buy and hold, or you trade a lot.
Right.
So don't do this in between stuff. Like, don't do stuff that does like a monthly rebalance, right? So you will get hit by 30% taxes in India, and at the same time, it is not, you won't reach this break-even stuff. Like, you can do that, infrequent rebalancing in India itself. You pay that STT and you finish it off, rather than doing it there. So you either do like something that takes a huge amount of turnover, or no turnover. Don't do in between stuff.
Right.
Did I miss anything? Did I cover everything else?
Yeah, I think you did.
All right. So with that, we'll close this this week's free float. Enjoy the post, and we'll see you next week.
Yeah. Thank you. Boom.